Now we are on the last leg of the show. After a brief lull, the Lal Street is abuzz again with fresh IPOs hitting the markets. Navigating one's way through this IPO rush may not be easy. While several IPOs may look attractive from the outside, as investors, you must go through the details before taking the plunge. So, should you subscribe to new IPOs? Also, do new fund offers deserve your attention to cut through this clutter and help you invest smartly and wisely? We have on board Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth Management. Feroz, good evening. Welcome to the show. Let's talk about IPOs now. What are the do's and don'ts one should factor in before thinking of putting their money in one?
Kavita, if you look at IPOs, IPOs are very seasonal, which are stock IPOs, right? So quite a few of retail investors actually want to participate in stocks which are just getting listed. So there is some advantage of doing that because quite a few companies, when they come into the space of being listed, they give some discounts or leave some money on the table. So if you look at it mathematically, the year of FY22, which was the last financial year, had the maximum number of IPOs, 66 of them. Numerically. In fact, in Anand Rathi Wealth also was one of those 66. 26 of them out of these 66 are in losses today. And that's a percentage is 40% of them are in losses if they were bought during IPO and held till date. Okay, most people in the retail space sell it at listing or somewhere thereabouts. But assuming they were held, 40% of them are in negative zone currently. This data I'm providing so that you know and what are the odds of making money. So this year we have had 23 IPOs and we've currently, if they were held and subscribed to and then held, 6 of them are at losses currently. So 70%, 73% of them are in profits and the rest of them, 27% are at losses.
So, looking at this number, do you think IPO should be a part of your portfolio, a part of your money-making strategy? If yes, how and when?
Kavita, there's a difference between money making and wealth creation. Can IPO fulfill if there is somebody who is sharp enough to understand and has a relative time flexibility? Can he make some money in IPOs? The answer is yes, because the demand and supply can be predicted of a new stock. Because on the last day, the subscription numbers are available. There is a gray market also, which is popular. So the point I'm trying to make is to make money, you can use IPOs. But I personally think the whole game is about creating wealth, not about making money. So would I ever subscribe to an IPO? I've never subscribed to one. So I would not recommend people to get digressed and use their energy towards making some money. You will make party money for that weekend or for the month. You might win yourself a small domestic holiday by going right there. But will you be able to create your wealth by doing IPOs? But the time consumption is going to be far, far higher than the value it can provide to an investor over the long run.
All right, so it just cannot be a part of your investment strategy. But then what about NFOs? Should we look at them?
Kavita, I personally think NFOs are not needed in one's portfolio. In fact, we at Anand Rathi don't want to recommend a scheme which has not finished 3 years of historical existence. Because when you are in an NFO, new fund offer, an asset management company launches new funds because it has a product bouquet which is incomplete. So the AMC is duty bound to create a product basket which encompasses all the niche possible. So they are doing their job. You as an investor can wait it out till it becomes an old fund because you don't have fund manager behavior. You don't have a portfolio created. You don't have an expense ratio of that fund also. So with such little information, only on a concept, why would you put your money? What is the hurry? If there are 491 odd open-ended equity schemes, what can't you find in these 491 that a unique new scheme can quench your thirst of a product gap in your portfolio? So I personally can't ever fathom to invest in an NFO unless there is evidence and there is something to analyze.
Here in this scenario, even the credibility of the AMC can't be factored in. If you talk about big AMCs, SBI, HDFC, ICICI, they've had superb and return gaining schemes as well. So that can't be factored in. This particular aspect can't be considered while investing in an NFO.
See, if you've decided to invest in an NFO, definitely the one which you mentioned is one of the most important thing, because what you can see is the AMC very clearly, right? So if you've decided to invest in an NFO, I'm saying that what you highlighted is the best way
Sure.
to choose,
Yeah.
right? Funds objective is the second method of choosing,
Okay.
right? Cost of investment with the anticipated inflow, which is that it's going to have. But the point I'm making is SBI, HDFC, ICICI, Kotak, all these are large asset management companies. They already have a bouquet of 10, 15 schemes, right? And SBI, when it does an NFO, it collects so much money from different corners of India, and penetration in the mutual fund industry increases. So that's great service to the penetration of the mutual fund industry. But if you're sitting in a metro and if you're an existing investor in the mutual fund fraternity, will I buy an SBI NFO or will I buy an SBI Contra where I know the fund manager is Dinesh? I know that the CIO is Vasan, who can do a great job and deliver me alpha over Nifty for the little fee they charge. So SBI NFO or SBI existing scheme, I would definitely choose SBI existing scheme with a known fund manager and his credentials.
Now, hypothetically, if someone has already put in money in an NFO, how much time should they give to the fund to perform, and then, for them to settle down with the performance and with the fund?
I think, Kavita, what happens is NFOs are so diverse in nature. In the last 1 year, you see NFOs of thematic schemes have been launched. They have done beautifully. Like if you look at the ESG theme, has done very well on the quant side, has given a 20% return, right? Since its NFO in November 20, right? So you're looking at quants to NFOs which have done very well. Now you have one ICICI Flexi Cap fund which has done 7.4%, but there are several other overseas fund of funds which have lost money as much as 45%. Invesco India Global Consumer Trend Fund has lost 45% of the money. When you look at the presentation, it looks fancy. Global Consumer Trends Fund of Fund. Of course, it looks fancy, so it's going to be attractive. You're going to invest it, but that's reasonable value destroyed. Whereas an Invesco multi-cap, which had a track record, which was a simple product, which was not so fancy, has done beautifully in our model portfolio.
All right, so these are the points and do's and don'ts that one needs to factor in while considering putting their money in an IPO or an NFO. But then, Feroz, since we have you on board, let's also answer our viewer queries, and we will move on to this section now. The first question comes from Pradeep Hinge, and he says that he's 35 years old, he's a salaried person, and monthly income is around 80,000. He's been investing in mutual funds through direct and growth option, and since last 5 years, and the portfolio that he's mentioned is Parag Parikh Flexi Cap, SBI Long Term Equity, SBI Conservative Hybrid, Mirai Asset Large Cap Fund. So these are the 5 funds that he has. He wants to know which of them should be out of his portfolio. He wants to buy a car in next 2 years, and the amount that he is aiming is around 12 lakh. Retirement, he wants for retirement, he says that he wants 1 lakh as his monthly income. And now, keeping these goals in mind, are his investment amount and investment strategy in line with it?
Kavita, if you look at the goals and the investing currently happening, which is 8,000 rupees, will that quench the thirst of the need of the goal for the investment? The answer is no. Especially because you have 2 years for your accumulation of your car's money, which is 12 lakh rupees. I'm hoping that's not the down payment for a fancy 50, 70, 80 lakh German car. If that's the full amount, then at least car loans come reasonably affordable. You have to only arrange for the down payment. So if for the car's goal, you will at least need 45, 50,000 for the car's goal, because you have only close to about 2 years left. So now let's look at the more important goal, because the car goal can still be deferred. Retirement is not so easy to defer for an individual. So 10,000 rupees if you invested, which you are currently doing almost 8,000 for 25 years. If the money grows at 14%, let's assume Nifty delivered 11, 12, and the fund managers you chose gave you that 2% extra. And if 14% was the compounded rate, you would get to 3 crore rupees. With 3 crore rupees, will you be able to get inflation adjusted 1 lakh rupee 25 years from now? Almost there, assuming an inflation of 4 to 5% for the next 25 years. So as long as you can take care of the car goal, your current investment should be able to take care of your retirement goal of 1 lakh rupee monthly income, inflation adjusted, because you have 25 years to retirement, and that's not a small period to ignore inflation.
All right, we move on. The next question comes from Sharvari, and she's 28 years old, salaried person, earns around monthly 60,000. Currently, she has a car loan of 4 lakh and paying EMI of that of around 10,000. She wants to retire at 60, and she wants to know if she'll be able to achieve this target before the time allotted for the retirement. The kind of funds she has in the portfolio: HDFC Mid Cap Fund, which was started in 2015, Nippon Small Cap Fund, and SBI Focused Equity.
Yes, Kavita, I think if she accumulated, now once her car loan is over, then that will create a larger disposable income out of her 60,000 rupee salary. If she invested 15,000 rupees for 30 years, she has almost about 32. Let's round it off to 30 at 14% compounded. She'll get to 8.24 crores. That's the benefit of starting early. She has age on her side. That's point one. From a scheme standpoint, she has one mid cap, one focused, one small cap. See, this is very clear. If you look at this portfolio, it's very apparent that it's not a well thought out strategy, because you've missed the flexi cap, you've missed the multi cap, you've missed the large cap, you've missed several other categories, and straight got to mid and small and one focused category. The focused fund, SBI focused fund, might not have delivered for the last 1 year, but that's a great fund. So continue with it. Nippon India Small Cap is also a very good fund. Continue with that. HDFC Mid Cap Opportunities, to our mind, requires a change. So you can move to HDFC Flexi Cap, add some more schemes to your portfolio so that you have a well-round portfolio, not just buying 2-3 schemes here or there. Kotak Emerging Equities, SBI Contra, Invesco India Multi Cap, are the other schemes which you can add to the portfolio and make it a more balanced portfolio with several categories rather than just small, mid, and focused.
All right, interesting question from a 28-year-old. We will move on, and next question comes up from Rajesh. He says that he is 38 years old, salaried person, works at an MNC, and he's been investing in mutual funds since last 8 years now. Annual income is around 12 lakh. The goals are he wants to buy a house costing 1 crore in 2 years. He also needs 20 lakh for his son's education and also plans to retire by 60. Now, the kind of investments he has is 3,000 rupees in Mirai Asset Large Cap Fund, 3,000 in Axis Flexi Cap, 2,000 in HDFC Small Cap, 2,000 in Nippon Small Cap Fund also, Feroz.
Yes, I think, see, if you have to buy a home of a crore, I don't think mutual fund is a vehicle interesting enough to create that kind of output in short spans of time. With your SIP of 10,000 rupees, I can tell you that if you increase your SIP every month, every year by about 10%, will you be able to meet your other two goals? The answer is yes. Your son's education requires 20 lakhs. You need 7,500 rupees static SIP. And retirement, you need 10,000 rupee SIP, which is continuously 10,000. At 14%, you will get to 1.75. So step it up. Get these two goals met by mutual funds. The short-term house buying idea, I don't think mutual fund can be a return spinner in the short span of time. Coming to the schemes, I would say you can exit the HDFC Flexi, a small cap, and Axis Flexi Cap, and add SBI Contra, Kotak Emerging, and HDFC Flexi Cap to your portfolio.
All right. So, barring the house thing, I think also we don't know apart from this what else lies in the investment portfolio. But further going on, if Rajesh wants to add on a new fund, should that be recommended? I mean, apart from increasing his investment amount.
See, I think because he has only 3 schemes in his portfolio, the schemes which we read out, like the Kotak Emerging Equities, HDFC Flexi Cap, SBI Contra, is automatically more because 2 schemes he's exiting and he's adding 3-4 schemes. So, would you need more SIPs? The answer is yes. A person should ideally, at your age, and you should have at least about 6 or 7 SIPs as well. That's the outer limit. So, you have headroom to add some more fund managers in your portfolio.
Last question. Prasanna asks you that which mutual fund category would be the best to invest, and that would provide a retiree a steady monthly income, and would a conservative hybrid fund be a right fit?
See, the two parts. If you're accumulating money for retirement, equity is the vehicle. If you've come close to retirement, then debt will have to form a part of our portfolio because you will try to consume the money. So, depending on which stage of life is Prasanna, if Prasanna, you're accumulating money for retirement, there's no better vehicle than equity schemes. There, you should not go for conservative hybrid if you're in the accumulation phase. If you just have 2 3 years to retirement, these hybrid schemes are definitely very good vehicles to shock absorb the market volatility and give you some recurring income. So if I have to tell you in the accumulation phase, you can look at Franklin Blue Chip, HDFC Flexi Cap, SBI focused equity, and Kotak Emerging. These are pure equity schemes. If you're 10 15 years away from retirement, they can really help you accumulate corpus enough to get recurring income. On the debt side, you can also look at in the accumulation phase, you can look at Aditya Birla's CRISIL Gilt April 2026 and IDFC CRISIL Gilt 2027, where only money is lent to Government of India and you get the indexation benefit to get effective post-tax return. But conservative hybrid funds are a good choice, almost closer to retirement or post-retirement.
All right, and after that, what is the kind of strategy one needs to make sure that there is a steady income from the investment amount collected?
Kavita, there is a provision in the mutual fund industry which is called SWP, which is Systematic Withdrawal Plan. When you actually activate a systematic withdrawal plan, units get sold partially on a specific day as per your choice, and the money gets credited to your bank account just like a salary. The power of SWP is that the full credit on your bank account is not completely taxable, because when you're selling units, there is a principal component, there is a gain component. The tax is only applicable on the gain component. So it's very tax efficient, very consistent, provides a cushion on your monthly recurring income which disappears post retirement, and taxation is only on a smaller component. Just like when you pay your house EMI to a bank, you're not just repaying capital, but you're also having an interest component. So it's a reverse EMI from a mutual fund to you, just like a bank takes from you.
All right, so I think that will be all in terms of queries that we have for you. Thank you so much, Firoz, for removing time and helping our viewers today.